I think it does make sense to spend a couple of minutes on distributors just to see whether those are a good area. Those generally have been good companies to invest in. And I think the short answer is yes. Last 5 years have been a pretty difficult time for active managers, especially if you aren't comfortable simply buying and holding the largest companies in the index, hoping for continuous multiple expansion from those. And in the last 5 years, it's been only that out of the 600 or so companies that have been in S&P 500, only 25% of them managed to beat the benchmark return. The total benchmark return, if I remember correctly, over the last 5 years is close to 100%. It's around 96%. If you simply owned equal weighted S&P, so meaning that each company within S&P would have been weighted equally as opposed to how it is actually in the index, you would have made about 66%. So that's a huge difference. That gap is unusually high. When we look at the data over the last 20 years or so, usually those two metrics kind of go hand in hand, and last 2 years have been unusual. As I already said, not that many companies in the index beat the benchmark return of about, which is about 14%, 14 to 15%. But distribution companies as a whole have done reasonably well. There's 26 listed distribution companies with market caps of billion or higher. And of those, 14 managed to beat the benchmark. So more than 50% compared to 25% for the index as a whole. So we think that just suggests that distributors are a good place to look for potential investment opportunities. We think one of the reasons why they do well is because inherently they have a business model that generates excess returns on capital. Returns on total capital employed based on measures. Based on the measures that we looked at, for distributors, you're getting about on average 20%. This is on trailing 12 months. You're getting about 20% return on total capital, where for S&P as a whole, this is unlevered. For S&P as a whole, it's only around 4 or 5%. So that gives you a significant, shows you that the distributor business models are advantageous, especially if done well. But it is very difficult business to be in because you are essentially what you're doing is you depend on moving goods as quickly, as efficiently as possible through warehouses at very low margins. And your profit margin does depend on how good you are at running your business. So it's a difficult business to be in. I think there's a certain competitive advantage that comes from being good at it. The publicly listed companies are usually the larger ones within the relatively fragmented industries. So what you're able, and those companies, I think as a result, do generate pretty decent returns on capital and decent returns to shareholders. Breaking down those returns a bit further, when we looked at the companies the 26 companies, as I already mentioned, 14 of them beat the index, others have not. If you look at the ones that beat the index, they on average delivered returns from what we would consider to be fundamental factors. So those would be growth in revenue, that could be growth in profit margin, that is dividends, that is reduction in shares outstanding. So on average, those companies have generated return from fundamental factors over the last 5 years of about 11.5%. The companies that didn't still did okay. They generated returns of about 8.5% from fundamental factors. So not as well, but still reasonable, reasonably enough, given that the S&P as a whole did about 6.5% from fundamental factors. But where the real outperformance came from is from multiple expansion. In the case of distributors that have done well, more than 15%, so 11% came from fundamental factors, but more than 15%, so from the total return of 20% plus, more than 15% came from just simple multiple expansion. So this is a non-fundamental factor, and that factor is cyclical. So you have to be pretty careful in terms of how we think you have to be pretty careful in terms of when you choose to invest in the companies and how you decide to hold these positions. These are not buy and hold for the most part, buy, hold, and forget for the next 10, 15 years. But you have to look at the industries and see the dynamics within the industry, the fundamental dynamics and how they're working. So for the companies that have done well, they got multiple expansions. The companies that haven't done well got multiple contraction. And that kind of explains a major difference in returns over the last 5 years. But then the question is, well, why did some companies get multiple expansions and others didn't? And in order to do that, we tried to apply a little bit of statistical analysis. I know that it's because we're only working with 26 data points, it's not statistically significant, but I think we have enough data to kind of get us in the neighborhood of approximately right from a point of view of looking to see what generally delivers good returns and has the potential to generate multiple expansion for the company. What we found that the factor that does the best in predicting that performance is whether you have a positive change in operating cash flow margin. So if the operating cash flow margin is expanding, that the company should be able to get a multiple expansion as well, because the market generally feels better about these type of companies. The other factor is, interestingly, is revenue growth together with cheap initial valuation, and we define cheap initial valuation by company that's trading at a free cash flow yield of 7% or higher. So when you have that and a revenue growth of over 5%, that's usually a condition for multiple expansion over time. Interestingly enough, when you just had one of those factors, so if the company was cheap to start with but did not have a good revenue growth, that wasn't necessarily enough to generate significant multiple expansion. But at the same time, when you're starting from high free cash flow yield, your fundamental return from fundamental factors is obviously better, because that free cash flow yield is something that you're getting as a shareholder if the capital allocation is correct. The factors that did not necessarily contribute that much is share repurchases. As I mentioned already, the revenue growth, and when you had a company that was growing fast but did not have a high free cash flow yield to start with, that wasn't enough to generate multiple expansion. And also if the company has spent a lot of money on acquisitions. Quite often, larger distributors do have the opportunity to be acquirers of smaller distributors, and those acquisitions could make a lot of sense when you can simply take the customers from the smaller distributor and plug them into your existing distribution network. That makes it more efficient, but that is not a factor that has shown to deliver multiple expansion over time. It does deliver revenue growth, so you have, once again, contribution to fundamental factors, but not multiple expansion. So that's our kind of view of the distributors as an industry that you could invest in. It looks like it's a good area to look for potential investment opportunities. And the company that I'm going to talk about today is a company that's we feel is going through a operational turnaround and is in the process of improving operating cash flow margins, which we think is a good place to hunt for companies, as we just shown based on the data. And that company is United Natural Foods, Inc., which is a largest grocery distributor in the United States, with roughly 20% market share, about $31 billion in sales, and EBITDA of slightly over $500 million. So, and that's, you can see, 30 billion of sales, 500 million of EBITDA. This is not a highly profitable business. And even a small change in operating margins can have a significant impact on the profitability of the company and how the market views the company. And you can also see from the price chart that we included on the slide that the fluctuation is in the stock is quite significant, with shares going from $10 to $50 to $10 again, and now at around 20, in the high 20s. So this is a highly volatile stock, but we also think it's a very interesting company